All right, so I pick it up again at this next slide. So I really don't want to spend a lot of time on this owner compensation because, again, for flow-through entities, um, well, just I'll mention a few things. Sole proprietorships, there's no compensation per se, just whatever uh, net income derived from the business is the sole proprietor's income. So if you look at a Schedule C, which we did in BA 333, you know that Schedule C looks like your typical income statement. You list your gross income, you list your deductions related to the business, and whatever's left over is the income that is transferred to line, I believe, 12 of the 1040. Uh, for S corporations and C corporations, they get to deduct employee compensation. S corporations and C corporations are subject to FICA, the employer portion. Of course, they have to withhold the employee portion as well, and they have to pay over to the IRS on a timely manner both the employer and the employee portions of FICA. Um, Owners of entities taxed as partnerships. Um, Gets a little trickier here, uh, but there's these things called guaranteed payments um, that we'll talk about in the future. Like we mentioned, if it's taxed as a partnership, uh, it's possibly subject to self-employment tax. And anyway, we'll look at that when we get to it. Partnerships, I believe, is chapter 21 or something like that, 22. All right, deductibility of entity losses. Again, we'll cover this. I mean, they cover a lot of stuff that we'll actually cover in more detail in later chapters. Um, you can't cover everything about every entity in one chapter, otherwise the whole course would be this one chapter. Um, but just kind of giving you an idea of NOL's net operating losses um, with the new tax law. If you are a C Corp, those net operating losses of a C Corp are not, if they're incurred after 2017, meaning 2018 or beyond, you don't carry them back. You simply carry them forward. Um, Unlike the old law, they were carried back for a couple of years prior, and then if you had any NOLs left over, you carried them forward for 20 years. Now you just simply carry them forward indefinitely. No carryback. Now, used to, you could offset up to 100% of taxable income in whatever year, either back those two prior years or going forward. Now you can only offset up to 80% of taxable income in a given year. Now note here for a C Corp, oh, went too far, that like I mentioned before, losses of the C Corp are not available to offset uh, individual shareholders' income. If they were an S corp, if they were any flow through entity, they would be able to take these losses, or, well, subject to certain limitations, available to offset owner's income. And so that's the point here. Losses generated by flow-through entities are generally available to offset the owner's personal income. And so here are the restrictions. And this was in chapter 9, I believe, of the book in BA 333. You're subject to basis rules. So you're limited to losses up to the amount of the owner's basis. Then there's the at-risk rules. So they can only limit their losses up to the amount that they're at risk. And then there's the passive activity rules as well. All right, so they go off on several other things. Let's see where we pick this up. All right, so they're talking about other tax characteristics, and so this is the bottom of page 18, and on page 19 and 20 they have exhibit 15-3. And again, we will go over all this in the other chapters. See if there's anything interesting here that I can direct you to. So notice with a C Corp, you have to have at least one shareholder, but you can have a single owner C Corp. Now notice the limitations as far as owners are concerned of an S Corp. You can't have more than 100 shareholders in an S Corp. So you'll find no S Corps that are publicly traded. Notice the types of owners you can have in an S Corp. You can't have other corporations owning shares of an S Corp. You can't have a partnership owning shares in an S Corp. You can't have non-resident aliens owning shares in an S Corp. And certain types of trusts cannot own shares of an S Corp. If any of those do own shares in an S Corp, it blows their S Corp election, and from the moment that any of those types of entities own shares of an S Corp, they're no longer an S Corp, they become a C Corp. And so one thing you'll find is sometimes you can blow your S Corp status inadvertently because you have a one of these impermissible owners. All right, so you might want to take a look at that. The rest of this stuff we will get to in due time in the subsequent chapters. Last but not least, well, if I start out as one entity, can I convert to another entity? Well, yeah, you can, but doing so may cost you. And so it's fairly easy for a flow-through entity to partnerships, LLCs, sole proprietorships, it's easy for one of those entities to convert to a C Corp. An S Corp can convert to a C Corp if a majority ownership agree to do it and they do it timely. But it's really hard for a C Corp to convert to a flow-through entity, because essentially what the C Corp has to do is liquidate and form as an entity that's taxed as a partnership. And when they liquidate, they have to essentially take each one of their assets that they own, and it's like they sell them at market value. And so they have to value each asset and take any gain on those and pay the taxes on those. So usually it's economically infeasible or unfeasible to convert from a C Corp to one of these other flow-through entities. All right, so we have some examples here. Some of them are kind of hokey, and some of them relate more to personal income tax than anything else. But I mean, when you set up the entity that you want, you have to consider both the taxation at the entity level as well as the owner level to see which one is best, especially when you've got either a single member or a couple of owners. If you've got multiple owners and you're a publicly traded company, well, guess what? You're probably going to have to be a C Corp, and you don't have much choice. But especially for the smaller companies, you may not want to be a C Corp, or you may want to. You just have to weigh the pluses and minuses, both the tax and the non-tax issues. All right, so anyway, we'll go through these. Nicole chooses to form her business as a C corporation, and she makes the following assumptions. CCS earns taxable income of $350,000. CCS will distribute all of its after-tax earnings annually as a dividend to Nicole. Her ordinary marginal tax rate is 32%, and her dividend tax rate is 18.8% because she pays 15% plus the 3.8% net investment income tax. If Nicole organizes CCS as a C Corp, what would the overall tax rate be on CCS's and Nicole's income? All right, so here's how you do that. So first thing you're going to do is tax it at the corporate level. The tax rate is a flat 21%. And so simply really easy, 335,000 times 21% is 70,350 at the entity level. And then the income that remains to be distributed, since all of it's going to be distributed to Nicole, that's 264,650. The dividend rate, tax rate on that is 18.8%. So she's going to pay 49,754. So you take the line 3 figure of 70,350, add it to the 49,754, and you get that sum on line 7 of 120,104. Well, you take that number and divide it into the taxable income of $335,000, your line 1 figure, and what you come up with is an overall rate of 35.9% taxable income. Yikes. That's a lot. All right, so assume that Nicole will organize CCS as a C Corp, and in spite of her best efforts as CEO of the company, CCS reports a tax loss of $50,000 in its first year of operation. Also, recall her marginal tax rate is 37%, and assume she will have ordinary taxable income of $200,000 from her husband's salary in that same year. How much tax will CCS pay in year 1, and how much tax will Nicole and her husband pay on the $200,000 of other taxable income if CCS is organized as a C Corp? Well, and they've simplified things here on the individual side because as you should know by now, your marginal tax rate is not the amount that you're taxed on all income, but they're simplifying things here and saying that the whole $300,000 or $200,000 is going to be taxed at 37%. So basically, the bottom line is CCS had a $50,000 loss, so they don't pay any income tax. But and the bad thing about C corps is Nicole and her husband don't benefit from the loss. It just sits there in the corporation until they get income in later years to offset. And so it's the 50,000 is considered a net operating loss. Okay, that net operating loss will sit there, can't be used by the shareholders, but it'll sit there until future years when hopefully CCS has net income to offset against the 50,000 NOL. So again, like I mentioned, they're simplifying the calculation on the husband's income, simply taking the 200,000 and multiplying by 37%. But hopefully, if you saw this before I said it, and you'd realize, well, that's not the way it works. We have on the individual side graduated tax rates, and it depends on your filing status as well. All right. Trying to find out where I'm supposed to be. I think I went the wrong way. Okay, so here we go. Entity loss example number 2. Suppose CCS is organized as an S Corp and Nicole's basis in her CCS stock before the year 1 loss is $100,000. How much tax will CCS pay in year 1, and how much tax will Nicole and her husband pay on the $200,000 of other income? Well, CCS is not going to pay anything, and since now the S Corp is a flow-through entity, the loss of $50,000 flows through to Nicole and her husband, and they can offset that $200,000 with the $50,000 NOL. So CCS pays zero, and Nicole and her husband pay $55,500, which is going to be $150,000 times 37%. So there's the comparison. So these are the kind of things you would do when you're talking to a client who wants to set up a business entity, to figure out which business entity is best for them. You would ask questions like, well, do you expect to have losses in the business, or do you expect to have net income, taxable income in the first couple of years? You know, if they're going to have losses, maybe they want to be flow-through entities starting out. They could always convert to a C Corp. That's easy. But it's, like I said, it's difficult to start out as a C Corp and then convert to an S Corp or some other flow-through entity. And so this shows how losses of a flow-through entity can be used by the in this case, S Corp shareholders, whereas C Corp shareholders can't use these losses. They just sit in the C Corp until the C Corp has taxable income in the future. All right, example 3. Suppose CCS is organized as an S Corp and Nicole's basis before the $50,000 year 1 loss is $100,000. Further, assume that Nicole does not participate in CCS's business activities. That is, assume she's a passive investor in the business entity. How much tax will Nicole and her husband pay on the $200,000 of other income? $74,000, meaning she doesn't get to take any of it because she's a passive investor. She's not allowed to deduct the loss. And so this assumes, of course, that you don't have other passive income, because if you recall, you can only take passive losses and use it against other passive income. Well, if she has no other passive income, she can't deduct it. She has to wait till she has other passive income to deduct the $50,000 passive loss. Example 4. Suppose CCS is organized as an S Corp and it incurred a $1 million loss for the year. This stuff we didn't cover, but I'll just go through it really quick. I think this stuff we talked about briefly in BA 333. All right, so Nicole's basis before the loss is $600,000. How much of the loss can Nicole deduct? Well, she can deduct $500,000. And so that's this $500,000 limit of excess loss limitation. And she can use all that excess loss limitation since her basis in the stock is more than the 500,000. If it was less, she would be limited to her basis. Now, the fact that she's married filing jointly, she can use 500,000. If she was single or married filing separately, she'd only use 250,000 of that loss. All right, so that's it for chapter 15. I will put out a lecture for each chapter on a weekly basis, and it'll be in the modules section.